you are getting stopped out for the wrong reason. Traders put their stop loss under support, under order blocks, under swing lows, and think that these are logical areas to put their stop loss. And this feels completely reasonable because traders are constantly taught things like support should hold, order blocks should react, fair value gaps should respect. So this is where most of the stop placement logic actually comes from. But using your stop loss like this could be a reason why you are consistently unprofitable. You see, price behaves differently all the time. One day it's directional, another day it's choppy. The next week it may be somewhere in between. Think about consolidation. Inside of consolidation, price rotates consistently. It revisits highs, it revisits lows, it trades back and forth between the same areas repeatedly. This is completely normal within this type of price action. Price can come back to the exact same area multiple times while the consolidation itself remains fully intact. Directional movement behaves differently. When price is directional, it pushes into new areas more cleanly, it revisits previous areas less frequently, and it spends less time rotating back and forth, which creates an important contradiction because the exact same pullback can mean completely different things based on the type of price action in which it happens. And this is where most stop logic placement starts breaking down. Because traders place stops under patterns, thinking that the pattern itself is the best way to define when a trade becomes invalid. But look at this example. Price is consolidating while continuing higher. The trader places the stop underneath the order block. Price revisits the area, sweeps below it, then continues higher afterwards. Now the trader thinks he got manipulated, or price came and hunted a stop loss. But have you noticed anything important? The price action never actually changed. Price simply continued behaving the exact same way it had been the entire time, which creates a major contradiction. Because if the price action never changed, then price sweeping the order block cannot mean the trade idea failed. So if you can't use patterns to tell you where to put your stop loss, what can you actually use? This is exactly where my approach to trading is completely different to everything you've been taught. Because I don't trade patterns, I focus on the price action itself. I focus on understanding what price is doing, and then I align my entry, my targets, and my risk with that price action. For example, if price is consolidating, I trade expecting the consolidation to continue. I sell at the top and buy at the bottom, because that is what price has been doing. I'm not expecting anything to change. I target an area where price has been consistently trading through, like the middle of this consolidation, and then I put the stop loss outside of the consolidation, because if price reaches that area, the consolidation I'm trading no longer makes sense. Notice what the difference is. I'm not looking for a pattern to tell me what will happen next. I'm positioning myself in a logical way with what price is doing right now. If you want to understand how I think about trading, you should watch my Seeing Price Clearly series. Now obviously, this doesn't mean that every stop loss should just be wider, and it doesn't mean that every trade you lost in the past was actually a good trade. The point is something much more specific. Most traders never question the logic behind their stop loss. They just assume that if they put it under a pattern like an order block, a fair value gap, liquidity, then price will just simply respect it. But once you understand you should position yourself differently based on the type of price action you're trading, you start realizing that the pattern was never actually able to make the trade valid in the first place. Because price coming back to an area does not automatically mean the price action you're trading has changed. And if it hasn't changed, then why would you get out of the trade? Most stop losses do not fail because the direction was wrong. They fail because the trader is using a flawed logic behind them.